Hello and welcome to this Friday's morning market briefing. We've got lots to talk about, but firstly, corporate defaults at highest rate since global financial crisis, says the S&P, as well as that oil hits 4-month high above $85 a barrel as the IEA predicts a market deficit. We've got lots to talk about in the charts also, with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure to subscribe. The first article to talk about is on the topic of corporate defaults. Now, as inflationary pressures and high interest rates weigh on the riskiest of borrowers, more companies have defaulted on their debt in 2024 than in any other start to the year since 2009. With this year's global tally of corporate defaults standing at 29, only beat by 36 in 2009, and that obviously that figure in 2009 obviously follows the financial crisis. Now, guys, this is a very important article, of course, to note and to talk about, largely because, of course, corporate defaults can be, a very good signal of where the kind of corporate economy is, of course, as a result of numerous variables and factors, as we're able to track what might be the effect of interest rates, inflation, and that kind of thing on these corporations. Now, of course, interest rates, inflation, employment data, these are all statistics that we commonly cover and kind of talk about in length and in depth, and obviously we've recently noted the trends in interest rates, and mainly we've been talking about, of course, when interest rates will start to come down and the effects that that's already having on the kind of stock market and that kind of thing. But I think this is a very interesting article because it kind of highlights the result, the impact that these higher interest rates have had on the US economy in particular here, but also the European kind of economy, including the Eurozone and the British economy. So it's a very important article to note, and as we've just noted, we're seeing record levels of corporate defaults, not seen since, of course, 2009, which is a very kind of crazy thing to think about, of course, because the financial crisis was the financial crisis in 2008, where we did see, of course, that kind of corporate collapse. So therefore, we would expect high corporate default rates. Yet the situation that we're currently talking about with, corporate defaults being at their highest rate since the global financial crisis, well, that's kind of surprising because we certainly didn't see the kind of long-term effects that the financial crisis did have on corporate on corporations as we are seeing now, because ultimately the Federal Reserve, when we did experience the kind of COVID shutdown, we did see the Federal Reserve and other central banks in advanced economies kind of respond to that by lowering interest rates, and so we didn't really see the effect that we might that we maybe saw in 2008 in the financial crisis on corporations, simply because those borrowing costs were very low still. But as we do know, in 2022 and then more importantly 2023, we saw record levels of inflation, which kind of pushed the central banks of these advanced economies in the Eurozone, Britain, and the US, most importantly, to start raising interest rates, and that is now seemingly what is causing so much issues for these corporations, and as a result causing certain corporations to default on their debt. What we'll get into though in just a second in this article, which I think is also an important variable to note in regards to corporate defaults, is the kind of consumer demand and how inflation is affecting consumers, and how that's now affecting these corporations. As we'll get into, subdued consumer demand is a large part to why we're now seeing these greater levels of corporate defaults. So I think it's very important to get into this article and start explaining what's going on. Now, the most indebted companies have seemingly been hurt by subdued consumer demand, rising wages, and high interest rates, which have made it hard for companies to repay debt. So just going over that once again, it's the subdued consumer demand, those rising wages and those higher interest rates, which are really affecting corporations and causing certain corporate defaults to take place on those most indebted companies, which I think makes puts into perspective the current economic climate quite nicely, because we're able to understand how this current economic situation that we're in the West, and how that's affecting corporations. So whilst we have noted before that these really large corporations, on the Nasdaq, S&P 500, FTSE 100, that kind of thing, we have noted before how these corporations aren't being affected as much as we might expect by interest rates, simply because they have a greater kind of cash reserve. They're more protected against these higher levels of interest which they have to pay on their debt, and as a result they're kind of able to stay away and not be affected as much. But as we have noted also, these smaller corporations are definitely being affected greatly by these higher interest rates, and it does seem that those smaller corporations, or even older and bigger corporations that own just lots of debt, are basically struggling during this time of really subdued consumer demand. We noted this issue especially within the automobile manufacturing industry, where we do know that, for example, in Germany, we're seeing a great deal of producers and manufacturing plants kind of move out the country, simply because we're not seeing enough consumer demand. And that's also affecting China and other nations around the world, which focus their kind of economy around producing consumer goods. So I think that's a very interesting kind of comment to make on this matter, as it kind of provides some more context to the issues that we've been noting for quite some time. Rising wages, that's another one that has kind of come in line with inflation, and something that we've kind of expected, and now we're really seeing the effects of that on corporations. Then finally, of course, high interest rates, which we've noted before, is a large issue for these smaller corporations with less kind of cash reserves, which are relying greatly on debt to kind of finance their kind of production and existence, basically. Now, well-known corporate names that have defaulted include GoTo and View Entertainment. Most of the defaults have been noted to be US corporations. That said, in Europe there's been more than double the number of defaults than in the same period in 2023. So we've seen a massive step up going into 2024 in regards to these corporate defaults. So it really does seem like there was that kind of lag period between higher interest rates and corporate defaults, and we're now seeing that play out. Now around half of all the around half of the companies which have been reported to have defaulted across the globe have been classified by the S&P as distressed exchanges. This is essentially where agreements that involve creditors receiving assets worth than the face value of their debt. It seems like the most consumer sensitive stocks are the most exposed to further potential of further defaults in the year of 2024. So think of some names here. We could definitely be looking at some other cinema names. I know AMC is a big one at the moment that's being discussed as a potential kind of default coming up as a result of this kind of higher period of interest rates, and we know that consumer demand has also dropped massively for cinemas recently, especially coming up the period of COVID. We've seen many kind of streaming platforms take over that service, and people just don't want to spend the money going out on the more kind of expensive luxury of going to the cinema. And so we're really seeing this issue develop within these really consumer sensitive industries. Added to that, it seems like the chemical and healthcare companies are at a high risk of defaults due to the high concentration of poorly rated incumbent companies with a negative cash flow. So very important article that we've noted here. We spoke about it for quite some time, but I think it's a very important one to kind of note here. The next article kind of will be explained further on the charts, and that's to do with oil hitting its 4-month high. Now, oil prices have now risen to a 4-month high following forecasts for excessive demand. This reversed a previous prediction of a surplus and now predicts demand to exceed supply. Now, of course, we cover oil consistently on the charts, and we've kind of been analyzing it recently for its lack of kind of volatility. Really, we've actually just seen price kind of stagnate over the past month, with price kind of ranging around the $83 a barrel area. That said, now it does seem like oil will be on the bullish move, bullish trajectory to the upside, and this is seemingly following oil being predicted to have excessive demand, which of course is now causing many individuals to start investing in oil. Now this obviously follows the recent articles that we have spoken about on the topic of the OPEC plus nations, led by Saudi Arabia and Russia, extending their voluntary cuts into 2024. And this, of course, was something that was expected by most, but is now seemingly affecting the way investors are perceiving the future for oil. With this kind of extension of voluntary cuts, as a result, eating into the supply of oil, and therefore creating this kind of lack of supply, which of course Russia and Saudi Arabia were hoping for, because they're looking to keep prices higher. What I think this forecast is very interesting in doing it is basically highlighting that they're also expecting excessive demand. So they're expecting more demand than previously noted. And when we've spoken about supply for oil recently, we have noted how that nations such as the US, Guyana, and others have kind of been expected to expand their oil production to new record levels, and so we kind of didn't expect this market deficit of oil. But at the moment, it does seem like we are going to see a bit of a market imbalance here on oil, as there will be too much demand for the commodity. Now, the price of Brent crude oil breached $85 a barrel for the first time since November yesterday, with this meaning now that oil is now up 11% this year. The IEA predicted that the oil market would be in a slight deficit this year after reducing its forecast for global supply growth to 800,000 barrels a day, down from 1.7 million in February. With this estimate now assuming that the voluntary cuts made by the OPEC plus nations to try and keep prices high will now remain in place for the entirety of 2024. In addition to this, the IEA updated its consumption growth forecast to 1.3 million barrels a day. Previous forecasts have expected a supply surplus for oil and predicting that there would be a record output from the US, Brazil, Guyana and Canada. It seems that hedge funds have also been slowly increasing their bets on oil prices rising since December 2024, according to recent COT data. These higher prices can now weigh on Joe Biden's fight against inflation in the lead up to the 2024 presidential election. So a very important article that we've covered here, and we are about to go onto the chart. So here we will, in the next kind of section where we're on the charts, we will then look and analyze the oil charts. So stay around for that. Next talk about, though, as we've just hinted to, is the charts, of course, where we do have quite a bit happening and a great deal of volatility in the markets yesterday and now going into the last day of the week. So to begin with, of course, we are on the US 30, more broadly talking about US indices, but here, of course, we are on the Dow Jones. Interestingly, the price did spike down to the downside yesterday. As price was, the day before in yesterday's market briefing, we were noting how price was sitting above this liquidity zone, which we did say was a great deal, which we did say held a great deal of liquidity and support for price. That said, price has now spiked to the downside and come into contact with this key Fibonacci level of both the 50% and the 6180, as well as that price interacted and has now tapped this key Fibonacci, not this key Fibonacci, this key bearish trend line, which is now seemingly acting as a level of kind of support for price, whereas previously it did, of course, act as an area of resistance. Now, the key thing that we're looking out for now is to see whether price will now make its run back to the upside after coming into contact with these Fibonacci levels. The reason why it seems like price did spike to the downside today is because the producer price, well, not today, sorry, yesterday, is because the producer price inflation figure did come in higher than expected, as a result reinforcing certain hawkish investors' beliefs that the Fed will be forced to basically keep the interest rates higher for longer to combat inflation, as we do know that producer price inflation usually is a great leading indicator for us to kind of see what the future of the consumer inflation figure will be, as whatever the producers are now paying for their goods is something that's also going to usually be translated to what consumers are paying for their goods. So that's why we have seen a great deal of movement yesterday to the downside, especially on the US 30, and as we'll get into in a moment on the dollar, we are getting that bullish action as we would expect, with some very hawkish data coming out. So very interesting positions to note on the US 30, and lots of opportunity going into next week, I think, after coming into contact with these key Fibonacci levels and seeing so much volatility really in the market. Next to talk about though is the dollar, which obviously kind of revert in an inverse image to US indices. In the US 30, we have seen a move to the upside, and this follows price coming into contact with this liquidity level, which we did know that price was in yesterday, and price was kind of struggling around that area to actually break lower. And it does seem like that figure that we did get in regards to the US producer price inflation has caused the dollar to move to the upside, as investors start to price in longer periods for interest rates in the US to stay at that higher level, as the kind of expectations for when interest rates will be cut this year is still around that kind of June-July period, and that piece of data could well be the the data which pushes that figure, that date for rate cuts to start all the way back to July. And that's why we're kind of seeing this move to the upside on the dollar. So definitely keep your eyes on the dollar. Very interesting situation at the moment to note. Next to talk about though is Euro USD. So obviously the inverse image of the dollar, where we have seen a sell-off as a result of that kind of producer price inflation figure that we did note. Interestingly though, price has broken below this key liquidity zone that we did note as an area where we expected a great deal of bullish liquidity, but price has broken below that level. So maybe price has a lot further to move to the downside. So definitely keep your eyes on Euro USD. Next to talk about though is pound yen. Not too much to say on pound yen at the moment. Price is still kind of ranging around. We were noting the possibility of an inverse head and shoulders pattern forming. That said, price is just so choppy at the moment on pound yen that we don't have too much to note of opportunity wise, and this is kind of in stark contrast to what we were seeing before March really, where price was coming into contact and reacting with all these key liquidity zones, but price is now seemingly kind of moved into a period of kind of consolidation, ranging, that kind of thing. Nonetheless, keep your eyes on pound yen, pardon me. Next to talk about though is Bitcoin, which is moving in an amazing fashion at the moment, and has now once again reacted with this key liquidity zone. So it does seem like price has now exhausted this Fibonacci extension level of minus 27.2%, which we did note in yesterday's market briefing as a likely area where price will sell off from, as people then begin to offload their longs, which they did collect and build up when price did come back and retest these key areas on the Fibonacci retracement tool. So that was a key area that we did note. What's surprising to see though is price once again retesting this area of liquidity that did act as a strong area of resistance, but we did see price kind of interact with that on Tuesday, so we weren't really expecting price to once again interact with that in a kind of meaningful manner. That said, yesterday's price action proved different, and price did come down and interact with this key liquidity zone. So the opportunities for where price can now go is obviously very kind of speculative and very interesting to kind of look at, but ultimately we're going to need to make sure that price breaks above this now range high for price to continue to the upside. So think about that when you're looking at Bitcoin. Next to talk about though is gold. Not too much to say on gold except from the fact that price is seemingly forming kind of this flag. We might see now price once again move to the upside before once again interacting with this liquidity zone that's seemingly acting as a very significant area. So keep your eyes on gold. Obviously price has been kind of hovering and interacting with this kind of 23.6% Fibonacci retracement level and liquidity box for quite some time now. Well, not quite some time, but in the past week. It's just whether price will break out of this flag today or next week, which is the real question. Lastly to talk about though on the charts, of course, is oil, which we've just noted on the articles, but of course here we can visualize that overwhelming bullish momentum that we have seen enter the market following those new forecasts for excessive demand and a lack of supply in the oil market. So price has made a significant run to the upside and is now in this old liquidity level that we haven't seen price interact with since November. So very interesting price action on oil at the moment. Definitely keep your eyes on that commodity. That's all to talk about in the charts though. Lastly to talk about quickly is the economic calendar, and we're getting some important data today. Not too much, but important data nonetheless, so we'll get through it very quickly. Firstly, we're getting the Chinese house price index figure, followed by the French inflation rate figure. Followed by that, we're getting some new Chinese won loans, as we have this entire week. Followed by that, the Italian inflation rate and balance of trade figure, so two important Eurozone figures. Followed by that, in North America, we're getting the US industrial production figure, and to round off the week, we're getting the US consumer sentiment figure. That's all the data though that we're getting today that's important to note in my opinion. But yeah, we've covered lots in the charts. We've covered lots in the articles, lots in the charts, and lots on the economic calendar. Hope you have a great trading day and a great weekend. Make sure to enjoy it. But that's all from us at Wildwood Capital. Have a great one. See you later.